Okay, welcome once again, almost at the end here. One more chapter after this chapter. Welcome to Accounting 101, Chapter 12, where we will be discussing long-term liabilities. As we know from Chapter 4, long-term liabilities are liabilities that will require payment in more than a year off into the future. Okay. They're not going to be paid off within 1 year or less. So they're going to extend into the future more than 1 year. Or the accounting cycle, whichever is longer. In my 50-some years, I've never seen anything longer than a year. So for all intents and purposes, let's stick with the year. Typically, we're looking at notes payable, mortgage payable, whatever. Now, two things you got to, again, most of this chapter is going to deal with bonds, how to account for bonds. I'm going to have to get my clipboard back up, so you're going to have to bear with me when I reach down, or if I try to reach down, I'll fall out of the chair, which will give you guys a good laugh. Whenever we have a series of payments that stretches for a period of time, you have a payment, and the payment has two components. Part of the payment is interest. Part of the payment is a reduction of the principal, the amount borrowed. You have a car loan, a 36-month car loan, and let's say you're paying $500 a month. I got to do some quick math here. Hold on here. 36. That'd be $18,000. Okay, so it's probably a used car, or maybe you put $20,000 or $30,000 down payment on the car. So each one of those $500 payments is, and let's say the amount borrowed was $15,000 and the interest is $3,000. So each payment, part of that $500 payment is going to be towards interest expense. Part of it is going to be applicable to reducing the $15,000 that you borrowed. All right. There's two ways to do this. One is the straight line method, which nobody uses. You only see it in textbooks. In real life, it is done using the effective interest method, which effectively says and works out that in the earlier part of the payment schedule, there is more of the payment. The interest component is the highest at the first payment, and each succeeding payment, the interest goes down a little bit, and the payment doesn't change. So then more of the payment goes towards the reduction of the principal, the amount borrowed. That is called amortization, which I learned last week comes from the Latin morte, death. So the death of the loan. When you make the last payment, the loan is dead. The liability is dead. You don't have to pay it anymore. Okay. So we'll keep that in mind. We'll see that a little bit later on in this chapter. So they're showing you that in Exhibit 12.1 is an amortization, and we got beginning balance of $20,000, and the principal payment is $5,000. The payment is $5,000, so you can see the interest goes $1,200, 62 total. I can't understand this. Oh, that's a total payment. Oh, so the payment reduces in this schedule of theirs. I've never seen that before. Total payment is $6,200, so $5,000 goes towards principal, $1,200 towards interest. So they're keeping the amount of the principal constant, and that's not right either. I'm sorry. Nobody does it that way. That is just a abomination there. Let's see how they have this worded. The Smart Touch Learning will make a $5,000 principal payment plus interest. Okay, well, that's how they structured it. So the interest, the total payment and the interest will go down with each succeeding payment, but you got to pay $5,000. That's a funny way to see a loan. Again, I've never experienced firsthand, and I've got a whole bunch of car loans and a whole bunch of miscellaneous loans and a whole bunch of mortgages. really don't want to focus too much on that. Just know that the point they're trying to make there is that the payment has two components, an interest component and an amount that reduces the amount borrowed called the principal. Mortgage payables include the borrower's, I promise. Okay, so let's see. They had $150,000 mortgage. They paid building. They paid $49,925 in cash, and signed a 30-year mortgage for 100 for the balance. Okay, at 6%. That is payable in $600 monthly installments, which include principal and interest. Okay, this one should be more towards real world, real life. Yeah, there's the figure 12.2 is the amortization table. You can do these on your computer. Just whatever search engine you use, you can go in and put loan amortization calculator, and several of them will pop up. And you can vary the amount, you can vary the interest rate, you can vary the number of payments, the time. Okay, and it's very, very useful too when you're buying a house or a car. You can look at, hey, I've never had more than a 15-year mortgage in my life, because I know there are two components to how much interest you will pay over the life of a loan. That is the principal amount you borrow, and the interest rate, and how long you borrow it for. By always sticking with a 15-year mortgage, I have saved hundreds of thousands of dollars. And the thing people don't realize is that for an extra $15, $20, $25, $40, $50 a month payment, you can go from a 30 down to a 25 or 20-year payment, and you save yourself a lot of money. A lot of money. In fact, not only did I at times never have more than a 15-year mortgage, a lot of those 15-year mortgages I had were bi-weekly payments instead of monthly payments, meaning I would make 26 payments a year, so effectively making 13 payments versus 12 monthly payments a year. So my amortization would be over the course of a little over 13 years, about 13 and a third, 13 and a quarter years. So, the 14th year and part of the 13th year, that's mine. That doesn't go to the bank. Yeah, think about it. If you're paying $3,000 a month, 1 year's worth of payments, so you can lop off, that's $36,000. You do that a couple times, and it adds up. 30,000 here, 30,000 there. Before you know it, you got 60,000. So let's take a look at this Exhibit 12-2 on page 12-4. And what do we have here? The mortgage of Smart Touch Learning, 2025 to, oh, this is a monthly amount. Okay. For the first year of the mortgage. So you can see the balance borrowed is in the first row. There's only one entry, and that's the balance, the amount borrowed, $100,075. That number will come down into the first column in the row immediately, the second row. Okay, so any row's last column becomes the first column in the next row down. Okay, the ending becomes the next row's beginning. Okay, and you can see there, the payment is a consistent $600 per month. So the first month, the interest at the end of January, the interest accrued is $99.62. Oh, I'm sorry, that's the principal. The interest is $500.38. So most of the payment, 5/6, 80%, give or take a little bit, is for interest. Very little in the reduction of the principal. Second payment at the end of February. Same $600 paid, but now the interest goes down to $499.88. The difference, the reduction of principal, is a little bit more. Let's skip down to December. I don't want to go over. You can look at all these month by month. At the end of December, that $600 is now $494 for interest, and $105 going to reduce the principal. I just got done, or will be done in May, with my mortgage, and I got shocked. Oh, no, I didn't get shocked. I knew it was coming, but this past year was the first time that I took the standard deduction on my taxes. Yeah, I don't know how long, because I had very little interest expense on my mortgage, which is deductible in 2022. Before that, I had a lot of interest on my mortgage because I had a pretty high mortgage. So again, keep in mind that when you amortize using the effective interest rate, each payment, more and more is going towards the reduction of the amount borrowed, the principal, and less for interest. Early on, you're paying mostly interest. Later on, you're mostly paying reduction of principal. Very important concept to keep in mind. They show you the interest there for the end of January, mortgage payable. You're reducing the liability, the $100,000 liability, you're reducing by $100, $99.62. Most of it, of the $600 payment, is going for interest expense. If you work that through, it would really, at the end of the year, or at the end of the mortgage, the last year of the mortgage, you see it's reversed. 500 is reducing the principal and 100 for interest. Very important concept to keep in mind. In fact, the higher interest rates are, the more you save by borrowing for a shorter period of time. Okay, let me get my tablet or my clipboard here, because we're going to talk about one of my least favorite investments. Well, one of my favorite lectures, talking about bonds. Investors, and if we want to look at society or in business in particular, we can group people and businesses various ways. I'm not going to say in infinite ways, but a lot of different ways we can categorize them. But for this discussion, let's look at them as people that need to borrow money, or people or businesses that need to borrow money, and people or businesses that lend money. And we're going to cut the banks out of this. Okay. Years ago, many years ago, centuries ago, again, business people, the successful business people, are usually fairly smart. Okay. And what does a bank do? A bank is an intermediary. We just had 3 big bank failures in the last 2 months. 2 out in California, or 2 in California, 1 in New York, and a Swiss bank. But the concept of banking, I think it goes back to old time Great Britain. Put their gold in, I guess the jeweler was the only person in town, in the village, that had a safe. And he found out that, people were giving him gold to hold for them. And after a while, there was not enough room in his safe, and it's all sitting there doing nothing. He said, hey, I'm going to loan some of this out, and I'm going to charge interest when people pay me back, and I can make money off of this. So that's how more or less the origins of banking in modern society came to be. There are people that have excess funds available to them, the investors, savers, and then there are people or parties, businesses, that have a deficit of funds, and they have to borrow. You want to buy a car, and you can pay cash, or you can borrow the money, financing. Okay, so as banks grew more and more in refined, and they got a pretty good deal here. There was a joke, bankers' hours, because they never had to work long or hard. They just sat there and did some paperwork every now and then, and made loans and collected on the loans, or defaulted on the loans, and took the property, sold the property, got the proceeds, and then paid the depositors. So they take money in from depositors, investors, and they don't keep it in the bank. They lend it out. Money sitting there doesn't do anything. So banks make money by lending it out. So they pay. Well, let's say they're 5% interest rate right now. So they're going to pay 2% on deposits to induce people to put their money in the bank, and then they're going to lend it out at 5%. So they're going to use some operating expenses, and then they're going to keep 2% for themselves. Okay, their profit. somebody else along the line said, hey, why should I go to the bank and borrow money? Because they're an intermediary, the middleman. It's only adding a layer of what I have to borrow. I can go right to the investor, right to the person who, or business, the party that has more money than they need right now, borrow from them, and I'll offer that to pay them 3%. Now the bank is only paying them 2%. So they're, if they're capitalists and they're driven by profit, they would rather 3% than 2%. Yeah, it's a 50% increase. And so the investor is profiting because they're getting a higher rate of return, 3% versus 2%. The borrower is profiting because instead of paying the 5% to the bank, they're paying 3% to the lender. They're eliminating the middleman. So the only loser in the deal is the bank. So they circumvent the bank, and this is big business on Wall Street, going right to the investing public, asking them to give you money in exchange for a piece of paper. In a great country, right? Thing is, that piece of paper is a contract. The contract says you're going to give me, usually bonds are sold in $1,000 denominations. If you read or ever saw the Wall Street Journal, sometimes when there's a new bond issue coming out, it'd be for $10 million or $100 million worth of bonds, and the initial public offering, and then they trade in the secondary market after that, depending on interest rates. But you can save a lot of money on both sides, or make a lot of money by eliminating the bank and going right to the source. It makes sense. Eliminate the middleman. Eliminate another layer of costs involved. So that contract that you give in exchange for your $1,000 is called a bond. And if you think about the definition of the word bond, if it's glue, it's gluing two things together. It's a contract. Okay, a handshake with a contract. I can't shake, left hand, right hand. Make it. It's coming together. Lender, borrower agree to something, and that's written on the bond indenture, the bond agreement. It's a contract. You give me money, I'm going to pay you interest so much at a certain rate for so long, and then at the end, I'm going to return you the money you lent me, the principal. Okay, so that's basically what a bond is. Okay, piece of paper. So they say here, company could borrow $100,000 from one lender at the bank, or they could issue 100 bonds payable at $1,000 to 100 different lenders, or to 50 different lenders, depending on how many of the bonds they want to buy. Each bondholder gets a bond certificate that shows the name of the company that borrowed the money, exactly like a note payable. It has a face value. It also has the amount. It's also the maturity value, principal value, par value of the bond. The company must then pay each bondholder the face value at the maturity date. In the meantime, they have to pay interest. People buy bonds. They're considered safer investment than stocks, but they pay a low return. Bond certificate states the interest rate that the company will pay and the dates when the interest is due, usually twice a year, semi-annually. Okay, so for a 5-year 9% bond issued at face value of $100,000, they will have 10 semi-annual payments of $4,500, because at 9%, whenever you see a bond interest rate, it's a annual amount. So if they pay twice a year, it'll be 4.5%. If they pay 4 times a year, quarterly, it would be 2.25%. Okay, they give you a little timeline there of what happens. You got all the, what was this for? Life of the bond. I didn't get the maturity value here. They didn't give it to us. Okay, it's a 5-year bond. That's right. For example, a 5-year 9% bond. So the bond will be sold on January 1, 2024, and it will mature on December 31, 2028, or January 1st, 2029. So in that timeline, they show you the issue price and the cash received, $100,000, and the cash paid at the end, and in between are those 10 annual payments of $4,500. $4,500 twice a year, $9,000. 9% times 100,000 is 9,000. A couple things we've got to learn here is the face value is the bond. Again, that's what it's denominated in. That's the maturity value. It's also called the par value, principal value. Maturity date is the date on which the amount borrowed has to be paid back in full. And the stated interest rate, or the face rate of interest, is the interest rate that is on the bond in ink. It's also called the face rate of interest, coupon rate, or the nominal rate. Now, there's different types of bonds: term bonds, serial bonds, secured bonds, and debentures. A term bond, all the bonds mature at the same time. Serial bonds, you may have, like they say here, $500,000 worth of bonds. Some are every year, or the 5-year period, $100,000 are going to be maturing. Secured bonds are ones that have collateral backing them up. Debentures are unsecured, just the promise, the good faith and credit of the company issuing them. So only the companies that have good credit ratings can issue debentures. Otherwise, you want a secured bond. Come on, scroll down, really. Okay, bond prices. Bonds can sell at 3 different levels. They can sell at their face value, they can sell at a discount, or they can sell at a premium. Now, what determines what they will sell at, face value, premium, or discount, is the relationship between the face rate that is of interest that is printed on the bond, what the bond is going to be paying, and the market rate of interest. Okay. So when the market rate of interest and the face rate or stated rate of the bonds are the same, the bonds will sell at face value. When let me do this. I'm going to use letter I to say interest rate. And when I'm going to put I subscript M is going to be the market rate of interest. And when I put I, lowercase I subscript F, is going to be the face rate of interest. Okay? Lowercase I is just the abbreviation for interest rate. Lowercase I subscript M is going to stand for the market rate of interest. And lowercase I subscript F is going to be the face rate of interest, interest on the bonds, the interest that the bonds pay, the interest rate. Okay? So when the market rate of interest is equal to the face rate of interest, the bonds will sell at face value, which is also known as the maturity value. Okay, so everything's in equilibrium there. Yeah, that's a little triangle with a line, and it says when they're equal, you're in equilibrium. Okay, that's a teeter-totter if you want, or a seesaw. Okay, so that's scenario 1. Scenario 2, the bonds are selling at a discount. So let's see what that means. That means the market rate of interest is greater than the face rate of interest. Now think about it. We have people out there that are investing. And if you're investing, it means you made some money, which maybe we can make a risky deduction that you're smarter than the average bear, like Yogi. And if you're an investor and you're pretty sharp, you're going to try and maximize your returns. So who's going to buy your bonds if the market rate of interest is 6% and your bonds are paying 5%? Who's going to buy your bonds? People are going to go and get the 6% interest in the marketplace. They're going to maximize their return. So in order to sell your bonds, you're going to have to sell your bonds at a discount. All right. So if the market rate of interest is greater than the face rate of interest on the bond, you're going to have to sell the bond at a discount in order to get people to buy it. How much of a discount? A discount equal in magnitude that the effective yield on the bond will equal the market rate of interest. Then people will buy your bonds. Okay, let's see if I can do this with my teeter-totter. Market rate of interest. Okay, market rate of interest higher than the face rate of interest. Almost knocked the computer on the floor. I'm all right. Computer's all right. Everything's good with the world. So when we discount the bonds, does Richard, and by discounting the bonds, we effectively bring up the yield where it will equal the market rate of interest. In the third scenario, the face rate of interest is greater than the market rate of interest. Okay. Scenario number 3, face rate of the bonds is greater than the market rate of interest. You can do it the other way if you want to say the market rate of interest is less than the face rate of on the bonds. Think about what that would do in the marketplace. If we're selling, if the market rate of interest is 5% and our bonds are 7% bonds, people are going to flock to buy our bonds because they can get 2% more than they can in the market. Well, what should a smart person do when customers are lining up outside and the line is around the block? What do they do in Florida when a hurricane is coming? The price of generators goes way up, as does the price of plywood. Price gouging, maybe, but it's the dynamics of supply and demand in the marketplace. So if our bonds have a higher rate of interest than the market rate of interest, we can sell our bonds at a premium. And what that will do, it will give the yield on the bond the same as the market rate of interest. So we will have a situation here where the face rate is higher than the market rate. Face rate higher than the market rate. So if we charge a premium, we can sell our bonds at a premium, meaning above face value. Discount is below face value. And what that will do, again, it will have the effect of equating the face value of the bonds with the market rate of interest. Oh, geez, what's that in there? Okay. So if we're talking $100,000 worth of bonds, if the market rate of interest and the face rate of interest are equal, the bonds will sell at a face rate. They will bring in $100,000. If the market rate of interest is greater than the face rate of interest on the bonds will have to sell at a discount. So the bonds will sell for less than $100,000, less than face value, and the amount will be the amount that'll make that teeter-totter seesaw. It'll bring the market rate of interest. It'll bring the market rate of interest back into equilibrium with the face rate of interest. When our bonds have a higher rate of interest than the market rate of interest, we can sell them at a premium. So they will sell for something over $100,000, and the yield will approximate the market rate of interest. It's really neat how that works, the market dynamics, free market system, capitalism. It's beautiful, beautiful, beautiful. And we'll see how beautiful it is. Oh, come on. Okay, bond prices. Now, what we're talking about in Chapter 12 is an initial public offering. That's the only time the company that issues the bonds is going to receive money from the investors. That is what we call a primary market, issuing it in the primary market, the IPO, initial public offering. After the bonds are issued and the investors buy them, those bonds can trade in the secondary market. Okay? The secondary market does not involve the issuing company. It involves two investors, two private investors, whether they're business or individuals, it doesn't matter. It's two parties that own the bonds. One party can sell it to a party. Party A can sell it to Party B. Party B can hold them for a while and then sell it to Party C. It doesn't involve the company. The only thing the company has to do is keep track of who owns the bonds so they know who to pay the interest to, unless it's a coupon bond. Then a bearer bond, whoever has the bond, rips off the coupon, takes it to the bank, and gets the interest payment. Okay. Bond prices are quoted in percentages. So they say a bond that is quoted at 100 is sold for face value, 100%. The second bullet there, a bond quoted at 88.375 or 88.375% is sold for 88.375%, or will bring in a $100,000 issue would bring, or here the $100 or $1,000 bond will sell for $883.75. And a bond that's quoted at 101.5 will bring in 101.5% of its face value, or $1,015. 10% would be a lot easier. So if it sells at 10% discount, it'll sell at $900 on $1,000 face value. If it sells at a premium of 10%, it'll sell for $1,100 with $1,000 face value. Now, regardless of what it sells for, face value, discount, or premium, at maturity, it has to be, the maturity value, face value, has to be paid off. So the $1,000 has to be paid on the bond when it matures, regardless of if it's sold at face, sold at a discount, or sold at a premium. And the difference, that premium or discount, we'll see soon, is what affects the actual yield, the interest income or interest expense to the bond. Okay. Waiting for the page to turn. Present value, future value. A dollar today is worth more than a dollar tomorrow, because the dollar today can be invested and get a return and be worth something You want to hear a good joke? Or not a joke, but something true to life. I'm an old guy, as you can tell. Uh, my first brand new car was a 1973 Subaru. $2,610.34 I paid for it. Maybe 64 cents. I forget exactly what the pennies were. $2,600 for a brand new car. Fast forward 50 years, brand new Subaru's probably going what, $30,000? Inflation. Yeah. Back then when it was $2,600, I was making $1.50 an hour. I'm making what, $30, $40 an hour now. Gas used to be 17 cents a gallon. Quart of beer was 45 cents. You can't get a glass of beer for that now. Yeah, the future value, present value tables are kind of neat. They can give you very powerful tools beyond the scope of this course. It can tell you how much you have to set aside to hit a certain target by saving with a certain yield, investment yield. It can tell you a payment 5, 10 years down the road, what it's worth today, given differing interest rates. It's really powerful financial things. I have a calculator here. I actually have two. A lot more buttons on this one. This is a simple add, subtract, multiply, divide. No square roots on this one. This is a financial calculator. A lot more buttons on it. Yeah, I got the numbers down here. The gray ones are numbers, but all these other ones are different functions. $50, maybe. I don't know. 60. I don't know what they're going for now. This one's 20 years old. Still works. I can do this. Is literally a mini computer. It can do future value, present value, are built in. So it's also built in your Excel spreadsheets, if you know anything about Excel. Very powerful tools that can help you when you're shopping for a mortgage, shopping for a loan, planning retirement, looking at different options of things that are available to you. Okay, bond interest rates. We just talked about that with that little piece of paper I had with the teeter-totters, seesaws on it. Market rate of interest is the effective rate of interest. What is going, and again, what do we know about interest rates? Interest rates go up and down all the time. Right now they're going up because of inflation and the Federal Reserve trying to rein in inflation, make it more costly to borrow money so people won't be buying cars, won't be buying homes, and that will have less dollars chasing the fixed supply. Things are out there, supply and demand. Again, that's economics 101, but you should know something about it. Let me give you an example here. They're using market rate is 10%. Now, the rate on the bond, the face rate of bond, that's printed in ink. To sell bonds to the public, you got to go through a registration process with the Securities and Exchange Commission. You got to do all these forecasts. You're working with investment banks and all. Nobody knows what the rate is going to be next week, let alone next year or 2 years from now when your bond issue is going to be taken to the public, because you got to go through all these things with regulatory agencies that protect investors. You type it up in ink, you think it's going to be this, and it's going to be something different, a couple points higher, a couple points lower. Sometimes you hit it right on the nose, but not too often. But that's what gives rise to the different value of the underlying bond itself. So you're going to give us a couple of scenarios here. With the market rate of interest being 10%, it's going to have 9% bonds. No, 9% are going to be our bonds, and the market rate of interest is 10%. And then the other hand, when the market rate is 8%. So let's just logic this out of what we just talked about 10 minutes ago or so. The bonds are 9%. Smart Touch Learning is going to borrow money from investors directly, and it's going to pay them 9% interest. But the market rate is 10%. So what's Smart Touch Learning going to have to do? Nobody's going to want those bonds. They're going to go to the market and invest their money at 10%. So in order to induce people to buy the bonds, for investors to buy them, they're going to have to make the yield on the bond equal to the market rate of interest. So they're going to have to sell, Smart Touch Learning is going to have to discount the bonds, sell them for less than face value, and an amount equal that will make the let's see, a $1,000 bond would be $90 interest a year. So that $90 interest on, say, $950 purchase price of the bond will give a 10% yield. Okay. The second paragraph down, let's say the market rate of interest is 8%, and Smart Touch Learning bonds are 9%. It's printed in ink. We've worked on it for a year or two, and we can't change it. People are going to be clamoring for our bonds, so we're going to charge a premium, and we can charge a premium equal to the amount that will get those bonds above face value, that will have that $990 interest per bond equal to an 8% yield to the investor. So literally making the interest rate on the bond equal in yield to what the investor would get in the marketplace. And again, the yield is adjusted up or down by the discount or premium, so that it will give that investor, it wouldn't make a difference to the investor whether they go to the market or buy our bonds, because they'll get the same exact yield. And that's market forces at work. Perfect example of it. All right, Exhibit 12.4, a summary of what we've been talking for the last 10, 15 minutes. The bond interest rate, you can see it's a constant 9% in all three scenarios. When it's equal to the market rate of interest, bonds will sell at face value. When it's less than the 10% market rate of interest, bonds will have to sell at a discount. And when the 9% is greater than the market rate of interest of 8%, you can charge a premium for the bond. And what that's going to do is going to equate the actual yield on the bond equal to the market rate of return. Okay, what we're going to call these things when we sell bonds, it's a liability. We're going to call it, bonds payable. Hey, it's a liability. Call it what it is. It's a bond. And what is it? It's payable. So we're going to be looking at this. In Chapter 10, we looked at it from the standpoint of the investors. Now we're going to look at it from the standpoint of the issuing company that sold the bonds. Okay. Debt is a less expensive source of capital because the interest is deductible and it doesn't water down ownership, doesn't dilute ownership. Okay, so they have a couple things. Plan 1, borrow $500,000 worth of bonds at 10%. And Plan 2 is issue 50,000 shares of common stock for $500,000. And they show you the effect of what those would do on using either one of those strategies, borrowing the money or selling stock. Okay. Straight line amortization method. We don't want to get into that because that is not how it is done. We're going to concentrate on the appendix of where we're going to use the effective interest rate method, because that's what you're going to see on the final exam. Okay. And again, on the final exam, I'm going to give you formulas for the columns. I'm going to give you a grid, and you're going to have to compute the grid and do some entries based on the numbers in the grid. Okay. Now, for the accounting for issuing the bonds and doing the interest payments and all that, amortizing the premium discount, is the same whether it's the straight line method or the effective interest rate method. The only difference is how much is going to be interest expense and how much is going to be a reduction of how much amortization is going to be each time you have an interest payment. So let's concentrate on when we issue the bonds. Here it says we're going to sell, let's see, market conditions. We're going to have to discount. So we have $100,000 worth of bonds being sold by Smart Touch Learning at 9% for 5 years, and the market rate of interest is 10%. So right now we know the market rate of interest is higher, so we're going to have to sell the bonds at a discount. Otherwise, nobody's going to buy them. So it says they will sell at 96.149%. So that's how much money Smart Touch Learning is going to get. $96,149. And then the bonds payable, always recorded at face value of $100,000. Now this is in the book, but I'm going to show it this way because I'm going to do it piecemeal. We sold the bonds. The bonds have to be recorded, always recorded at their face value, $100,000. That's what we're going to be paying off at maturity value. So let's record it as that. Now, they sold at a discount, so we only got $96,149. I've said it many times. Debits and credits have to be equal when we write a journal entry, each and every time. So we need $3,851 in the debit column to make that entry balance, and that will go to an account called Discount on Bonds Payable. Okay, that's what it looks like. Now, I want to flip over to, well, let's see what happens if they show you the next one here. Okay, now we want to go to the appendix here. Appendix 12B on page 12-28, the effective interest amortization method. The same numbers are used that they use in the main body of the chapter for the straight line method. The only thing is the straight line method is an inaccurate portrayal. Okay, so once again, we have $100,000 of bond being issued by Smart Touch Learning, 9% bonds, 5-year life. Okay, so we know that the bonds, well, sure, they sell a premium. First one, did I go 2 pages or? Yeah, I went 2 pages. So Exhibit 12B, or actually 12B1, very similar to what you're going to see on the exam. I'm going to put an extra column in there and change the columns around a little bit. But, and again, I'll head the columns A, B, C, D, and I'll give you formulas how to compute them out. But in this case, you can see that on Exhibit 12B, on January 1st, 2024, the day the bonds were issued, there's only one column has a number in it, and that is the carrying value or book value of the bonds. And the book value of the bonds would just be the bonds payable with its discount or premium. Discount is going to be a contra account. Premium is going to be an adjunct account. We'll see that later on when we sell the bonds at a premium. We're going to get more than $100,000. Okay, so the premium account is going to be adding to it the book value. So that's our book value at the outset of the bonds, January 1, 2024. Okay, now what you need to do here is every time we pay interest, every time there's an interest payment, that's every 6 months, we are going to amortize some of that discount, because we want, if you look at that Exhibit 12B-1 on page 12-28, you can see at the end of the life of the bonds, 12/31/2028, it is showing the carrying value as $100,000. So we got to get that $3,851 of premium out of the way, off the books. We have to amortize it away. And the way we do that is adjusting the interest expense, not the interest payment. The interest payment will always be the face value of the bonds times the face rate of interest on the bonds, prorated for half a year if they pay interest twice a year. Okay. So you can see the cash payment is going to be a consistent $4,500 each of the 10 payments, twice a year for 10 years, or for 5 years, 10 payments, $4,500, $100,000 face value of the bonds times 9% face interest of the bonds times 6/12 of a year, $4,500. Okay. So how do we get the interest expense? Well, they show you in the blue there. Well, let me put this all down on paper. I mean, you have it there in Exhibit 12B in the blue boxes with the arrows showing where the numbers come from. So the interest payment, they call it cash payment. I call it what it is, interest payment. Equals face value of bonds times the face rate of interest times the portion of year. So there it is. $100,000 worth of bonds is the face value. 9% is the face rate of interest, and they pay interest twice a year. So 100,000 times 0.09, 9% interest per year, times 6/12 or half a year, it's $4,500. Interest expense, on the other hand, is going to be computed by taking the carrying value of the bonds times the market rate of interest times the portion of year. Okay. So in this case, no, I should put numbers in over here. I'll put them in the margin. I got room here. $100,000. That's the face rate of the bonds. Times 9%. $100,000 face value, 9% face rate, times 6/12 of the year. $4,500. 100,000 times 9% times half a year, $4,500. Now for the interest expense, we're going to use the carrying value of the bonds less their discount, $96,149 times the market rate of interest of 10% times 6/12, and we get 4,807. Carrying value of the bonds times the market rate of interest times half a year, 4,807. The difference between the interest payment and the interest expense is the amount of discount we're going to amortize. Interest expense, 4,807 minus 4,500 interest payment. Okay, there it is there. The amount of discount to be amortized is the interest expense less the interest payment. Interest expense of 4,807 less the payment of 4,500, 307. Now, every time you pay interest, the interest expense is going to change. So the discount, the amount of discount that's being amortized every interest payment is going to change. Okay. The market rate of interest is going to continue to be 8%. The interest payment is going to be $4,500. So let's look at again at Exhibit 12B1. Cash paid, interest payment, cash payment, $4,500 consistently. That interest expense, that first one, 4807, is the carrying value of the previous row times the market rate of interest of 10% times half the year. Okay, that 307 is the difference between the interest expense and the interest payment. Now, that amount of discount that was amortized is going to be added to the carrying value. That's where they get the 96,456. That's the original proceeds of the bond, 96,149. Add back the amount of discount amortized to get a new carrying value of 96,456. Multiply that by 10%, and that's where you get the interest expense of 4823. Subtract the 4,500 interest payment, and that's the amortization on the second payment. As you can see, the amount of discount that is being amortized increases with each payment, as does the carrying value of the bonds. The interest expense also increases each payment because the carrying value of the bonds is going up. Pretty straightforward. Once you'll do it a couple times. If I were you, I would take that tablet, or I'll send out a grid, and you can try to fill it in. Now let's go over and see what happens when there's a premium. Okay, so here we are on page 12-30, exhibit F 12B2. Okay, $100,000 worth of bonds, 5-year, 9%. Market rate of interest is 8%. That's the information in the paragraph summarized. So, if our bonds are paying 9% and the market rate of interest is 8%, our bonds are going to sell at a premium. And they tell us $104,100. So we will get cash, and we have to record the liability for the bonds payable, and that's ours at face value. And got 104,100. Again, piecemealing it to show you that the bonds are always recorded at their face value, what their maturity values, how much we're going to have to pay. And when we redeem the bonds, and the bonds sold at 104,100. So the difference has to be a credit of $4,100, and that'll be called premium on bonds payable. All right. If we scroll down to Exhibit 12-B, what's going to happen? Notice the cash paid or the interest payment is the same as it was with the discount, $4,500, because it's face value times the face rate of interest times a portion of the year. Now, the interest expense is different. It's less than the cash payment, than the interest payment. In a discount, it's more. Okay. Now, how is that computed? Same way, except it's going in the opposite direction now. Let's get this down here. Cash paid is what they call it. I'm going to say cash paid, interest payment. Is face value times the face rate times percent of year. Okay. Okay, did it a little bit different this time. I use the abbreviation. Face value times the face rate, interest, subscript F, face rate of interest times the portion of the year, 100,000 times 9% times 6/12, $4,500. Same as it was with the discount. Now, interest expense with the premium. Same formula. Carrying value times the market rate of interest times the percent of the year. So now the carrying value for the first interest payment is the proceeds of 104,400. The market rate of interest is now 8% times 6/12 of a year. And what do we get? 4164. Okay. Carrying value of the bonds times the market rate of interest times the half a year. $4,164. What's our payment? $4,500. So our expense is less. When it's a discount, our expense is greater than the payment. So how much is the amortization of the premium? Again, that would be the interest payment cash paid less the interest expense so that would be the screwed up here interest payment 4,500 that's the expense of 4164 so it'd be 336 of the premium. All right. And you just do that computation each time you pay interest based on the previous row's carrying value. As you can see, in both Exhibit F12B1, the total of the premium, the total of the discount amortized is $38.51, the amount of the discount. Here, with Exhibit 12B-2, the total premium amortized is $4,100, which is the amount of the premium. Now, didn't show you this, but some T accounts here. I'm going to use the ruler and make it look nice. Yeah, and I move the ruler so it doesn't look nice. All these T accounts I have in my office, I don't have any here at the house. Okay. Bonds payable. Discount on bonds payable. Okay, I just set up some T accounts here for what we just went over. Bonds payable, it's a liability account, and these are the modifying accounts. Discount on bonds payable, premium on bonds payable. Now the bonds payable, always recorded at face value, right? And I put the $100,000 in that liability account. Now in the first scenario, we had a discount of $38.51, right? It's a discount, so it's offsets. This is a credit, so the discount will have a normal debit balance. So the book value, carrying value, book value would be 96.49. What's that? Go back. 96.149. Okay. And on the premium, it was 4,100. 104. 100. So that's how it would look. You'd have the liability account, bonds payable. What are you going to pay to the investors when you pay them back? $100,000. But you sold them for $96,149. So the amount of the discount, that's the carrying value. As we amortize the discount, this is going to go down to zero. So when at the end, you'll have a zero in this account, and the carrying value of the bonds will be $100,000. So the carrying value is going to go up with each interest payment. When it's a premium, we're going to amortize this is going to get decreased, and this is going to go to zero. So after we do 10 interest payments, we're going to have completely amortized the premium. We'll completely amortize the discount too. And what's left at maturity will be the face value of the bonds. One last thing to show you, and that would be the entries needed. Let's go back to the first scenario where we have the discount situation, and go right to the table. Has all the information we need. So on 1/1/24, we got the cash. We issued the bonds. I'm going to abbreviate B/P to save time. Bonds payable, and we got 96,149. And again, to reiterate it, bonds payable, BP, bonds payable, recorded at maturity or face value. There's the proceeds because they sold at a discount. The balancing figure of 38.51 is the discount on bonds payable. Yeah, that's a debit balance. So on June 30th, we have our first interest payment. June 30th, 2024. Okay, so we're going to pay cash. How much cash are we going to pay? $4,500. What is that going to do? Well, we're going to have interest expense. And the interest expense is $48.07. Right from the table. So what do we have here? We have a situation where we have more debits than credits. So I have to credit something, and I have to credit something $307. So now my debits and credits are equal. And what is that? That's the amortization of the discount. So say discount on bonds payable. And there we have it. Okay, you can, I'll do the December 31. Yeah, I got enough time for December 31. Again, the cash payment, each and every one of those 10 payments, it's going to be $4,500 credit. December 31, my expense is $48.23. $323 difference between debits and credits. Notice, here's what we did earlier. We had the bonds payable at a discount. The discount has a debit balance, right? $38.51. What are we doing here when we're paying it? We're crediting the discount on bonds payable. That's the amortization. And eventually we do that. Once we post it, all 10 of them, this is going to have a zero balance. That 38, this 38.51, as we credit them, it's going to end up with a zero balance. At maturity, we're going to have to pay $100,000 of the bonds off. For the premium, it's got to work a little bit differently though. With the amortization, it's going to be a debit. Again, working off Exhibit 12B-2 with the premium. On January 1, 2024, we're selling the bonds at a premium. So we're going to get $104,100 cash. Bonds payable, always at face value. Again, I'm piecemealing it so you can see the effect and figure it out logically instead of having to memorize it. I've got in $4,100 there, and that's going to be premium on bonds payable. June 30th comes around, we make our first payment to the investors of the interest payment. The interest payment is always going to be $4,500. We're paying it, so it's a credit to cash. Our interest expense comes right from that amortization table. It's accounting value times the market rate of interest, which in this case is 41.64. And again, I have an inequality in my debits and credits in that journal entry, but I can make it balance. If I put 336 in the debit column, I now have $4,500 in debits and $4,500 in credits. All I need is an account. Well, what is that? That's the amortization of the premium on bonds payable. Yes, it really is that simple. I'll do the next one for the December 31st. And it's again, we have the cash payment of $4,500. Interest expense. Let's see, gotta look at the table, 41.51. Again, I'm short on the debit side. How much? $349. And that is the premium on bonds payable amortization. Okay. That was, I hope, informative. I hope it was enlightening. And I hope you'll look at it, read the book, look at it, and read the book. Repetition is time consuming, but very beneficial. All right, we'll be talking to you later this week or next weekend with the solutions for chapters 11 and 12 assignments and chapter 13. And then we'll be ready to take the final exam.